2 chapters on inventory. Notice some of the terminology you need to pay attention to, because we're going to be talking about the lower of cost or net realizable value, and then lower of cost or market rules. So they're two different things, and a lot of times people get them mixed up. Some other issues: gross profit method, retail method, and then presentation issues. These are actually a pretty good place on where you can see everything they're going to talk about. So when you're reviewing, these would be a good thing to go through to see what kind of things I need. So we're going to be talking about all of these items, so I'll let you read through those. More of the lower of cost or market. This one was the previous one was the lower of cost or net realizable value. Just what it is and how you do it. Then the lower of cost or market, how that's different than the lower of cost or net realizable value, and various other things. Okay, we're also going to talk about the gross profit method and the retail method. This book kind of complicates the retail method. We'll talk about the complicated part of it and then how to simplify it for things that are normal. And then finally, presentation analysis. So it looks like it's pretty short, but please look through these types of things when you're studying to make sure you understand that. Okay, so net realizable value is basically the net amount you can realize. So it's kind of, think about if I had some old t-shirts that had the year 2019 on them, pretty soon they're going to be kind of outdated. So net realizable value would be what you could sell them for, the net amount you can realize. But if you had to ship them out, so whoever's going to buy your t-shirts, let's say they're going to buy all 200 of them with the year 2019 on it, if you had to incur shipping costs to get them to them, then that would be subtraction from the selling price. So it's less reasonably predictable costs of completion, disposal, and transportation. So if for some reason you are working on them and there was a flaw in them, but you went ahead and completed them because you could still sell them to recoup your cost, you would subtract the cost of completion, disposal, etc. So that's net realizable value, the net amount of cash you're going to realize. So you take the selling price minus the cost. So this is the one that's over here. Assume that Mander Corporation has unfinished inventory of cost $950, had a sales value of $1,000. It's going to cost us $50 to complete them and $200 to sell them. So what's the net amount I can realize? Well, I simply take the selling price minus the cost to complete or sell, and I end up with $750. So net realizable value, honestly, the only thing difficult is mixing it up with lower of cost or net realizable value with the lower of cost or market. All right, you can read through that. Okay, the next thing as far as applying the lower of cost or net realizable value, the question becomes, do you apply it to individual items? So if you notice, you can go through these. I've got frozen foods and canned foods, but I also have total inventory, which is comprised of frozen and cans. And with in each category, I have individual items. So my question is, do you need to take each individual item by itself? So in this one, it compares 80,000 to 120 and uses the 80, 100 to 100, that's not a good one, 50 to 40 and uses the 40. So I do it on an individual item basis, taking the lower of these two, and I get 384. I'm going to jump to total inventory. If I added up the cost of all of it, added up the net realizable value of all of it, I would use 415. So in this case, the cost is lower. And then the last one, do I take it by major categories? Whereas all of frozen foods would be 230 cost compared to the net realizable value of 260, and this one is flipped, etc. And the answer is, there are 3 ways to apply it. You can use any of these. So all of these are acceptable methods as long as you remain consistent with it. Okay, the next question is, All right, so if I do have to write it down to net realizable value, what does the journal entry look like to write it down? So notice I have my cost is 82,000 and my ending inventory at net realizable value is 70. So I'm going to write it down. So I've picked one of these three methods, and notice in this case I'm not going to write it down, but in these two cases I will. So if I was using the individual items or the categories approach, I would need to write it down. All right, so I need to write this down. There are two methods to do it. One's called the loss method. And notice the credit is the same. I'm getting inventory down. There's also an allowance method, which we'll get to in a second. But these two I write inventory down, and in one case I say it's a loss. The other one, I throw it to kind of the hold all account for inventory adjustments, which is cost of goods sold. So hopefully the name tells you what you do. The loss method uses a loss, and the cost of goods sold method, which is an expense, debits an expense. The third method is the allowance account. And the allowance account is used when I want to keep inventory at 82,000. So just like when I have an allowance for accounts receivable, I keep my accounts receivable at the gross amount, and I credit an allowance, which is a contra asset for the difference. So the allowance method, I would debit the loss. Notice they, under the loss method or the allowance method, they also debit a loss. They don't debit cost of goods sold, and they credit an allowance. And this is a contra asset, so what it looks like on your balance sheet is I'll have inventory at cost less my allowance, and then I credit it for my net realizable value. Note that this one is probably more often used, mainly because if I have inventory, there's a subsidiary ledger for inventory, which means I would have to go back through and write down the individual peas and carrots, et cetera, for all of those items that I had. Whereas if I have an allowance, this 12,000, I don't have to assign it to specific products because there's no subsidiary ledger for the allowance. So this one is, if you were doing it, you would probably choose the allowance method, because then I could leave my inventory on their books like they're on my books for, with all the subsidiary accounts that add up to 82,000, and I can credit an allowance account to account for the adjustment. So notice that's a contra asset. Let me pause here. Okay. So notice what it looks like on your balance sheet. In both of these cases, inventory is at inventory less the allowance is at 758,000. One is just in one account and one of it's in two accounts, so I net them. Most people would pull this over and actually have 770 less the allowance and have 758 over here. Okay, again, notice how the loss method, the cost of goods sold method, just where it's shown. In cost of goods sold, the loss is buried in cost of goods sold, and under the loss method, it goes to other revenue and expense section of your income statement. So it does impact gross profit in different sections of your income statement. All right, now we're going to move on to last thing that we could talk about is, notice the allowance is a contra asset. So as a contra asset, it maintains its balance. So if I'm going from 12,000 and I need my allowance to be 7, I actually need to decrease my allowance by 5,000. So I would flip this entry there. But anyway, so the allowance account is an asset, so you actually need to change the balance to what you need it to be, just like the allowance for bad debts. Okay, so now we're going to move from the net realizable value method to the lower of cost or market method. This actually gets more complicated later. Okay, so lower of cost or market is a very strange name, because lower of cost or market is replacement cost. Okay, so make sure you know that lower of cost or market is replacement cost. And when you use this, use it for companies using LIFO or retail methods. And so it's an exception to the lower of cost or net realizable value. So it is this method, but it's an exception to this method for these types of companies. All right, so make sure that you know that market is replacement cost. All right, so here's where it gets really complicated. Okay, the replacement cost has a ceiling and a floor. Okay, so the ceiling is not more than net realizable value, and the floor is net realizable value less than normal profit margin. So we're going to go through some examples on that. Here's a quick one right here, the simple example. Oops. Pause. Okay, so assume that Parker Company has unfinished inventory with a sales value of $1,000, estimated cost of completion and disposal of $300. So notice, just like before, our net realizable value is $700, so that's our ceiling. And then I subtract a normal profit margin of 10% of sales. So 10% of selling price is 10% of 1,000, so $100. So my floor is 600. Okay. So these are my ceiling and my floor. This problem doesn't tell me what my replacement cost is. But if my replacement cost was below 600, I would have to use 600 because I can't go below the floor. If my replacement cost was above 700, I would have to use 700 because I can't go above the ceiling. And that'll become clear in just a second. So notice the ceiling is 700, the floor is 600. So if your replacement cost is between there, I'm golden. If not, I use the ceiling or the floor. And I'll just do some. Okay, so this one is this problem right here. So fill it in as we go. So remember, here's where people mess up. Your overall, let's see if I can find this. Your overall goal is to compare cost to market. The problem is the steps to get to market are so long. By the time you figure out the market, you forget what the market was. Okay, so remember, it is market is replacement cost, but it can't go above the ceiling and floor. So what I generally do is I get the ceiling, the floor, and the replacement cost, and I just circle the middle one. So you can see I did it over there. What that actually looks like, let me see if I can get some text going here. Let's just do the first one, spinach. Let me see if I can type in the numbers. So we have a net realizable value of the ceiling of 120,000. There we go. Okay, and I have the floor of 88,000. Okay, as long as the replacement cost is not above this, I use the replacement cost, and if it's not below this, I use that. So I put my floors wrong, so let me back up and get my right floor, 104,000, okay? So my net realizable value less the normal profit margin. So notice that my replacement cost is down here. Type. Okay, so in other words, the replacement cost goes below the floor, so I need to use my replacement cost. So in a good way to do this, I mean, if you visually need to draw it out, just draw 120,000 at your ceiling. I can't go above that. I can't go below the 104,000. So if my replacement cost was 130,000, I can't go above the 120. So I stop there. But in reality, what happens to implement this, I'm clearing all those. To implement this, I technically just circle the one in the middle. So 88, 120, 104, 104 is in the middle. So 104 is my market. Okay, so it's replacement cost with a ceiling and a floor. So I'm limited to that. Now, remember, that just took quite a while. But the whole overall goal is to compare your cost, this column, to what I put in this column. So I went through that long process to put 104 over there. So now I compare my 80,000 cost to my market of 104, and 80,000 is the lower of the cost or the designated market. Okay, so right here, I should have gone over there. Cost or market. Market is my ceiling. My floor is 104. Replacement cost is below it. So I can't use replacement cost. So I'm going to draw that. Put an X through that. So I stop at my floor of 104. Okay. All right, so let's go through a couple of the other ones, and then you can just pause the tape and see if you can follow them. But let's go to this one. My cost is 100,000. Now I need to determine my market. My ceiling is 100. My floor is 70. My replacement cost is 90. It's in between there. So I use replacement cost of 90. I compare it to 100, and 90 is lower, so I'll use that. Cut beans. I have my ceiling of 40, my floor of 27.5. My replacement cost is above my ceiling, so I circle the middle of these. I get 40,000. I compare the 50 to the 40, and I get 40, the lower of those two. And so you can kind of go through those. So notice it adds up to 350,000. And then, as I said before, we can use any of these. I can use the, looks like I had that someplace already. But any of these are acceptable ways of doing your inventory. So here I could use 350, 370, or 374. Okay, and so here's my journal entry. So notice it's, whoops, if I had a total there, I might want to do that on yours. Total that up, put 415 right there. I can't draw really good, so I'm going to erase that. Draw 415 there. I have 350,000 there, and so the difference is 65,000. I need to get it down. So under the allowance method, I credit the allowance and debit loss. If this were the loss method, I would debit loss, credit inventory. If it was cost of goods sold method, I would debit cost of goods sold, credit inventory. Okay, so I'm not really sure why they go over that twice. Okay, so so you can kind of read through some of the evaluation of those, etc., which are very important, but you can read. Okay, here's another one, and I will just kind of go through maybe A and B on it, and you can follow. But I like it because it has more numbers on it where you actually have to figure out net realizable value. Okay, so didn't really download or copy on it, but I have a 2000, we have Remmers Company manufactures desks. The company attempts to obtain a 20% gross margin on selling price. On December 31st, 2012, I pulled this from a prior edition because I liked this. The following finished desks appear in the company's inventory. So I have a 2012 catalog selling price, a FIFO cost basis. So right here, let's just stop. Here's our cost, 470, 450, 830, and 960. And I put it right there, cost, 470, 450, 830, 960. Notice this is just mine. This will not be given to you, so you will do it yourself. So you need to compare cost to market. So I'm going to be comparing this line. Don't really have one here, zero, but I'm going to be comparing this line to this line at the end, but it's going to take me a while to get there. So the first thing that I need to do is I need to figure out my ceiling and my floor and my replacement costs. So let's do the replacement cost first. So I've got my costs and my estimated current cost to manufacture at December 31st. So this is my replacement cost, 460, 430, 610, 100. So that's my replacement cost. My ceiling, notice I have sales commissions and estimated other costs of disposals. So I know I'm going to subtract those, and my 2013 catalog selling price. So notice I have a 12 selling price and a 13 selling price. So the 2012 catalog was effective November 12th, and the 2013 catalog is effective December 1st, 2012. And I want it as of December 31st, and so I need to use the 2013 selling price. Okay, so in each of these cases, my ceiling is the selling price minus the disposal costs and the cost to complete. So 500 minus 50, so this one would be 540 minus 60, this one would be 900 minus 80, and this one would be 1200 minus 130. So that is your ceiling right there. All of those. My floor is that ceiling minus 20%. I'll pause here because I just read it and I can't find it. Oh, there it is. 20% gross margin on selling price. So I have a 20% markup on selling price. So 20% of 500, I subtract 100. So my floor is 350. In this case, I would subtract 20% of 540, 20% of 900, and 20% of 1200. So you can go ahead and compute those. And then I pick the middle one because the replacement cost dominates, but this is the only, not the only one. In this one, my replacement cost is between the two, so I use replacement cost. Pulling that 430 down there. And in this one, I use the replacement cost and I'm pulling down there. In these, the replacement cost is 610, but I can't go below the floor, so I have 640. And in this one, it is 460, but I can't go above the ceiling, so it's 450. So in other words, once again, if you just pick the middle one of these three and write it as market. So now I'm going to compare the 470. You know, honestly, this would be quicker if you just compared the 470 by the one you put the star by. 470 compared to 450, I use 450. 450 compared to 430, I use 430. 830 compared to 640, I use 640. 960 compared to 1,000, I use 960. Okay? So make sure that you kind of think about that. Okay? Make this. Okay, now the next one, again, remember how I said the biggest thing about here is getting confused? So we first have lower of cost or net realizable value. Then we have lower of cost or market, which uses net realizable value as the ceiling. And then we simply have net realizable value. So the question is, when can you simply use net realizable value as my value for inventory? And these are the requirements: a controlled market with a quoted price applicable to all quantities, no significant cost of disposal, or, so this is an and, so 1 and 2 or 3, or it's difficult to obtain cost figures. Okay, so probably the best instance of when I simply don't keep track of cost and I just value my inventory at net realizable value, the best example of that is commodities. So let's say I live in Illinois and I'm a farmer and I have a corporate, large corporate farm where I would actually file financial statements. Okay, so if you really think about that, if I'm going to keep track of the cost of my crops, I have fall work that I do, I have herbicides, I have other chemicals that I put on the ground, I have fertilizer that I put on the ground, I have the seed, I have a variety of other things I do. Maybe I have GPS systems, I have my tractor, etc. But I could keep going on and on and on. So the thing is, if I have it for several fields and I'm doing it on different types of commodities, etc., what I'm trying to paint a picture for you is the very, very difficult thing it would be to figure out the cost of an individual commodity. Okay? So notice that I can, in aggregate, know all of my costs, and I could probably go about it, but it would be very difficult, especially if I use the same tractor for different crops and had chemicals on different fields, but some of them were kind of different because they were different commodity, etc., etc. Okay, but if you turned on the TV, so what I'm trying to do is cost figures are very difficult to obtain. Okay? If I turn on the TV every day about noon, or if I Google it, I can find commodity prices right there on the TV that says corn is at X dollars a bushel. Okay, so let's say that it's at $4.50 a bushel right now, right there. And if I know I harvested, let's just keep it simple here, 100 bushels at $4 a bushel, that is $400. And notice that I can very quickly get a valuation. So in this case, there is a controlled market. You have the commodities market with a quoted price applicable to all quantities. Nobody keeps track of whose corn they have. And the costs of disposal are not significant. You do have to haul it to an elevator, but it's not significant as far as the compared to chemicals, etc. And the cost figures are all very difficult to obtain. So notice in this case, I would simply use net realizable value. The net selling price minus the cost to disposal, I still subtract them even though they're not significant. And you may say they're immaterial. But notice, differentiate that from this one, lower of cost or net realizable value, lower of cost or market, or when do I simply use net realizable value? Okay, so I'm going to actually stop here because we're down to 26 minutes, and I think that's a good place to stop and cut off. We will start at relative sales value lump sum purchase next time.